Welcome back to the channel. I'm David, and today we're diving into a powerful strategy for second act investors: how to turn your traditional IRA into a dividend income engine. If you're looking for reliable, passive income in retirement, you're in the right place. Before we jump in, let's quickly review the 5 second act investor portfolio engines. 1. Employer 401k, your stability engine. If you're self-employed, you can open a business 401k or a business Roth 401k. 2. Roth IRA, your high-octane growth engine. 3. Traditional IRA, your dividend income engine. You can roll over old employer 401ks into this account. 4. Health savings account, your triple tax advantage medical savings engine. 5. High-yield savings account, your liquid emergency fund engine. Together, these engines create a rules-based framework for building lasting wealth. With consistency, discipline, and objectivity, a rules-based investing system empowers you to make sound decisions and stay focused on your long-term financial goals. Let's get started. So, what exactly is a dividend income engine? It's an investment approach where you focus on assets like stocks, ETFs, or index funds that pay regular dividends. Over time, these dividends can become a steady stream of income, supplementing your retirement withdrawals and giving you more financial flexibility. Why use your traditional IRA for this strategy? Because a traditional IRA offers tax-deferred growth, so you don't pay taxes on dividends or capital gains until you withdraw the money. This means your investments compound faster, and you can reinvest those dividends to buy even more income-generating assets. Let's break down the steps to transform your IRA. Step 1. Review your current holdings. Start by looking at what's already in your IRA. Are you holding mostly growth stocks, ETFs, bonds, or cash? Identify which assets aren't contributing to dividend income. Step 2. Research dividend-paying investments. Look for high-quality dividend stocks, ETFs, or index funds. Focus on companies with a strong history of paying and increasing dividends. Think utilities, consumer staples, or dividend aristocrats. Here are some of the top U.S. dividend ETFs. DGRO, iShares Core Dividend Growth Fund. VIG, Vanguard Dividend Appreciation Index Fund. DGRW, Wisdom Tree U.S. Quality Dividend Growth Fund. SCHD, Schwab U.S. Dividend Equity ETF. VYM, Vanguard High Dividend Yield Index Fund. FDVV, Fidelity High Dividend ETF. Personally, my dividend engine consists of DGRO, VIG, and SCHD. Disclaimer: I'm not a financial advisor, and nothing here is financial advice. I'm simply sharing my personal journey, the mistakes, the lessons, and the systems I've used to rebuild my second act. Investing always involves risk, and past performance never guarantees future results. If you need personalized guidance, reach out to a certified financial professional who can help you build a plan tailored to your situation. Let's get back to learning. Step 3. Diversify for stability. Diversifying across sectors and geographies is essential for reducing risk and ensuring a steady income stream. Given today's macro environment and anticipated global trends, such as de-dollarization and rising U.S. debt, adding international dividend ETFs to your portfolio is a logical strategy for achieving stability and long-term growth. For international exposure, consider these ETFs. SHWI, Schwab International Dividend Equity. VYMI, Vanguard FTSE All World High Dividend Yield ETF. LVHI, Franklin International Low Volatility High Dividend Index. IDV, iShares International Select Dividend. DWX, SPDR S&P International Dividend. VIGI, Vanguard International Dividend Appreciation. DVY, Franklin International Core Dividend Tilt Index ETF. EFAS, Global X MSCI Super Dividend EAFE ETF. FIDI, Fidelity International High Dividend ETF. I personally invest in SHWI, VYMI, and LVHI. To easily compare how these U.S. and international dividend ETFs perform, check out the dividend calculator linked in the description. It lets you view total returns and analyze dividend payouts across custom time periods, helping you make informed investment decisions. Step 4. Reinvest dividends. To grow your dividend engine, you should reinvest dividends to buy more shares. This accelerates compounding and grows your future income potential. As your dividend engine grows, you can build out a monthly income engine. As an example, I use my monthly dividends to expand my international sleeve. As of February 2026, international dividend ETFs have outperformed U.S. dividend ETFs since 2025. Having both a U.S. and international dividend engine reduces drawdowns by spreading risk across different markets and economic cycles. In my IRA, I've also built out a monthly dividend drip engine consisting of JEPI, JP Morgan Equity Premium Income ETF, DVO, Amplify CWP Enhanced Dividend Income ETF, GPIX, Goldman Sachs S&P 500 Premium Income ETF. As of February 2026, my monthly dividend income engine generates $1,034.54. Income I use to rebalance my account when necessary and to increase my dividend ETF holdings. Each quarter, I direct 30% of my monthly dividend income into a single income ETF. JEPI in March, DIVO in June, and GPIX in September. This keeps contributions systematic and helps the monthly income engine compound predictably. Step 5. Monitor and adjust. I review my portfolio twice a year, every January and June. Not to make frequent changes, but to ensure my rules-based strategy is being executed as intended. This regular check-in gives me the opportunity to adjust contributions and rebalance if necessary, keeping my investments aligned with my long-term goals. Remember, the objective is to invest, not trade. As you approach retirement and begin planning withdrawals, consider a Roth conversion strategy to help lower your future tax burden. We'll dive deeper into Roth conversions in a future video. Let's look at a simple example. Imagine you have $100,000 in your IRA, allocated across several dividend-paying ETFs, each yielding around 4%. That's $4,000 a year in passive income, and by reinvesting those dividends, your income grows every year. Personally, I'm currently receiving a little more than $26,000 in annual dividend payments in February 2026, with a goal to generate $50,000 in dividend income by retirement. So how do you build your own dividend income engine? Start with a clear goal. Invest consistently, reinvest every dividend, and let the income compound. It's important to remember that every investment carries some risk. Dividend payments aren't guaranteed. Companies can reduce or suspend them at any time, and ETF prices can fluctuate with the market. With a traditional IRA, you'll also owe taxes on your withdrawals in retirement. However, one advantage of investing in dividend ETFs is that if a company cuts its dividend, the ETF will typically remove that company and replace it with a stronger dividend payer, helping to maintain the fund's income potential. Always factor these considerations into your long-term plan. Here are some final tips and takeaways. Start investing early to maximize compounding. Focus on quality and consistency, not the highest yield. Rebalance your portfolio as you get closer to retirement. Our preferred method is by new contributions or DRIP reinvestment, not by selling assets. Avoid lifestyle inflation. Increase your annual contribution rate with every raise. Optionally, consult a fixed-price financial advisor or use AI to tailor this strategy to your goals. Transforming your traditional IRA into a dividend income engine can bring peace of mind and financial security throughout retirement. If you found this video helpful, please give it a thumbs up, subscribe for more investing tips, and share your favorite dividend ETF, stock, or fund in the comments below. Thanks for watching, and I look forward to seeing you in the next video.